Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark runs down the action on the major financial markets. Realty consultant Ross Kay says the Canadian real estate market is turning down this year. Real estate writer Hilliard MacBeth says we're just not used to seeing declining home values. And Mackie Research's Payton Nyquvest gives us the lowdown on Canada's equity markets. We'll talk to Ross Clark right after this.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
We're chatting with Ross Clark. He's an investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Pleasure to be with you, Jim.
The U.S. dollar reigning supreme over the last couple of weeks.
Yes, it really has. It's, the dollar took a big pause in the last year or so, but finally managed to do its breakout in the last week, and particularly since it had been strong leading up to the election, took a bit of a pause, but since the Trump election here, we've seen just an excellent rise in the dollar index, puts the trade-weighted index, the DXY as we call it, DXY, up around the 101.5 level, and we haven't seen these levels since back in 2003. So it's pretty impressive, and especially against the euro and the yen. There have been some significant moves there. Now, we've been bullish on the dollar index, but as part of this move, we're thinking it might be a little ahead of itself. Probably looking for it to peter out within the next week and a half and have a bit of a setback. Needs to hold above 97 on the index. If it does that, then I think the first half of next year can look pretty favorable for the dollar. And the other side of the equation would be the precious metals, which have been had a pretty rough week. We've got gold down to 1208, had a break in the silver market as well, and it's part of what I think will end up being a bit of a basing process still that will take us into the early part of next year, probably through into January, before we're looking at a reasonable low as far as precious metals are concerned. And with gold just now testing close to that $1,200 level that we saw as support last spring, I wouldn't be at all surprised in the coming week here that they managed to take out some stops under $1,200. They just love to go through those round numbers, whether it's on the way down or on the way up, and before you get any type of a decent bounce.
U.S. equities seem to be doing decently well after the Trump election. We didn't have the big bounce downwards that they saw in Asia and Europe.
No. Well, they were down initially, literally overnight on the election, but then bounced back extremely well. A Brexit style of move here where we've had the good upside. But, the bulk of that action was completed by Monday of this week. And then we spent the rest of the time pretty much consolidating. If we took a look at where the leadership was, it was, as we thought, it wouldn't matter who had been elected. Infrastructure was going to be a play after the election. And clearly, you take a look at the names, any of the what would be shovel-ready type of companies, Caterpillar or that type of thing, they had pretty big surges in that first 5 trading days, but have now done a bit of a pause. And if we think back to a year ago, when the Trudeau government was elected here in Canada, you had that initial move with companies like Aecon and SNC-Lavalin that were deemed then to be would be beneficiaries of a Canadian infrastructure program that would gear up. Well, you get that initial surge, but in reality, there aren't a lot of those projects that are shovel ready and can get up and go. So the enthusiasm, it becomes far more it becomes ahead of itself as far as market action is concerned. So when we're looking at the stocks that have run right now, I think you should be looking for a pause and a pullback. Don't get too aggressive on them because they're probably pricing in a good part of the move already.
Governments, of course, move at the speed of a charging glacier. The NASDAQ touched on a record high on Friday. Any chances that's going to be maintained?
It had, we've been seeing a real shift as far as the market's concerned. The NASDAQ, the Russell, doing exceptionally well. I would expect that you're going to continue to see some strength there. And you have to remember where we are in the year. We've gone through what is historically one of the worst periods as you go through September, October. By the time you're coming out of October into November, you're part of that best 6-month stretch. And for this week coming up, the day prior to and after U.S. Thanksgiving, which is this Thursday, has just an excellent track record on the upside. We should remember, too, that the Russell 2000, the small cap index, we're only a few weeks away from that period, middle of December, where it tends to then be very strong relative to the big cap names as you go into January. So, I think people should be looking at things in a favorable mode right now.
Ross, do you have any papers coming up?
I've done some work regarding the dollar index and gold, and just recently, and that is something that people may be interested in taking a look at.
Check out Ross's email, ross.clark@cibc.ca. Ross, thanks for being on This Week in Money.
Nice to be with you, Jim.
We've been speaking with Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Coming up, real estate consultant Ross Kay, next on This Week in Money.
Always consult your investment professional before making any investment decision.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the 4th largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're chatting with real estate consultant Ross Kay from thewealthyhomeowner.ca. Ross, the latest national and provincial numbers for real estate have come out. What are the real numbers and what has caught your eye?
What's caught my eye? Okay. So I think when the show we've gone over the situation in Vancouver and the fact that we've already called, I think last time I was in the show, pretty much obvious it was a 21% house price correction that's already underway. That has not changed. The data, our year end, so how we measure a housing market is we measure on a trading year. So in the same way that you can't sell corn futures on a calendar year, you've got to be selling them on how the season that the corn is going on, or how you can't talk about a hockey season when it goes from one year to the next. In other words, it doesn't follow a calendar year. A housing market is exactly the same. It does not follow a calendar year. So for us, we follow what's called a trading year, and the trading year ends on October the 31st. Now, when you separate the market into the periods that exist in a trading year, and you know how to read them, you know exactly what has gone on in Canada for the last 36 years. The measurements are so precise, Jim. We hadn't gone back to in all honesty, because we didn't have a need to. We never went back to 1980, bringing all the data, the 12.7 million homes that our market intelligence covers. We didn't go back that far and look at it in terms of the trading year. we know how the trading year worked. There just wasn't a need for us because we know how numbers work, and to try to explain it, it's difficult. That being said, a trading year is precise. The periods that we record are exact. We are talking 99.01% for the unit sales from 1980 till October of 2016 we have tracked. We know where those people sold, we know where they bought. There was only a 0.99% that we cannot account for. We also know that those will be recorded in the next few months. In terms of trading volume, between 1980 and today, there has been approximately $3.1 trillion spent in the Canadian housing market from 1980 till today. My firm has tracked 97.3% of every dollar ever spent. We can track that because we know how a trading year works, and we know how the periods interact with one another. We know that for 2 periods of a trading year, money is taken out of the housing market and put on the sidelines. And then in 1 period in a trading year, the same period every single year, the money comes off the sidelines and back into the market. And when the money comes back off the sidelines into the market, that's where your house price growth takes place. What I can tell you is this. In the last period of the trading year, which concluded on October the 31st, 2016, nationally, home prices in Canada dropped 6.7%. That is the 3rd biggest October 31st drop since 1980. Actually, the 2nd, excuse me. And 1990-91 was not the biggest drop. The biggest drop actually was October of 2008. October of 2008 was the biggest percentage drop in the Canadian housing market in history. What happened October 2008, Jim?
Well, we had the big crash.
That's right. There was the big crash. Now, in that year, housing prices in the period where we measure dropped $22,800. $22,000 nationally. This October, we recorded a $34,000 drop in the national average selling price in the last period of this trading year. That is 150% what it was back in the crash of 2008. It's because housing prices are where they are, we're only at a 6.7 versus a 7.3% crash in 2008. That is the second greatest percentage crash in the history of Canadian real estate. Our data only goes back to 1980. And it is the largest single period deflation in the history of Canadian real estate.
What's responsible for it?
What's responsible for it, obviously, is Vancouver, British Columbia. That section of the country has held a greater percentage of the average selling price and a far more higher percentage of the trading volume that has been ongoing. But the only market in Canada that did not have a negative last quarter of the trading year was Ontario. That was the only market where the housing prices did not drop below what they normally do. They always drop. They always drop in the last period. Just nobody hears about it or nobody understands it because nobody follows a trading year other than Ross K. Realty Consultant. You'll hear about the year-end numbers. Our year-end for the real estate market ends October the 31st, not December the 31st. Imagine taking a hockey season, cutting off the first 2 months of the year, cutting off the last 2 months of the season, and only talking about the middle of the season. Or carrying 2 months of the old season into the new season and not counting the last 2 months of the new season. No one would ever know who won the Stanley Cup. And that's how housing is approached by economists, academics, and so-called housing experts. And that's not how a housing market functions. A housing market functions on a trading year. It follows trading cycles. The realty market is not the housing market. That's why when we tell you Canada has just had a $34,000 drop in average selling price in the last period of the 2016 trading year, that is a historical record.
How big of a factor is Christy Clark's 15% foreign buyer tax in the Greater Vancouver area when you take in the entire Canadian picture?
Zero, because you're only going to hear about the impact of her tax when the government updates you with the October 30th closing data. All of the data that the government has released today, including September's, where there were basically no foreign buyers, are all the sales that took place before the tax was even talked about. Only now, in October, will any sales that took place after August the 2nd start to be reported as closed. So everything that every reporter in British Columbia has told the British Columbia public about foreign buyers leaving the market and then saying the government data proved it has been lying to the public. Now, they've been lying because they've been ignorant to what they've been reporting on, but they're still misleading every single reader of that information. You are going to find, when the government reports about October 30th closings or October 31st closings, that there are no foreign buyers buying in Vancouver because they haven't been buying even before the tax was established. They just are not there. When I tell you that we have tracked 97.3% of every dollar spent in the Canadian housing market from 1980 till 2016, it's because that's what we do. So we know exactly where there's a hole in the numbers, which has allowed us to reveal the, we refer to it as a currency exchange Ponzi scheme. We did, obviously I'm not going to insinuate it's money laundering. I'm still not going to insinuate it's money laundering, although some of the press have reiterated that possibly that's what's going on. But that's why we came forward with that $10 billion hole, because we know it exists. It wasn't in the real estate data. We also know right now there are no holes in BC numbers. We know you have no foreign buyers buying at this particular moment in time, unless they're buying brand new homes and it's being covered up.
How could you cover it up?
How could you cover it up? The closing information that appears on a new build can be facilitated in a couple of ways. And when that gets reported at the land registry office, the lawyers have the ability to make it appear that, well, whether appear from a technical standpoint, it is a local purchase. But from a practical standpoint, it's not. You can't do that in the resale market because names appear on the paperwork, both sides, and those names can be tracked. Now, I still will go back and say that my belief is that if the developers in Vancouver and British Columbia are not reporting foreign buyers to FinTrack, I personally think they should be prosecuted. But, That's just my ethical standpoint.
Ontario's premier has said she is not going to bring in a foreign buyer tax there, although Christy Clark said the same thing days before they brought in a tax.
Yeah, well, they won't bring one in Ontario because there's only one market in Canada that is not turned red, and that is the Ontario market. And this is a government with, I think your Christy Clark government has a low public approval rating. Well, the one here in Ontario, we're talking in the tank. So they brought out just the opposite. They brought out this week, we're going to help first-time buyers. Now, anybody who knows if you're going to add more buyers to a housing market, then odds are the consequence will be that your prices are going to go up. What they did in Ontario is they brought in a policy that is a non-policy. They basically said they're going to rescind the land transfer tax by an additional $2,000, which, on top of the new lending requirements that CMHC has established as of October 17th, renders that $2,000 difference a non-factor. In other words, if people are the people who are still that are left, the few people, first-time buyers that are still left, who can qualify for a purchase in the province of Ontario, specifically the GTA, probably where this solution was targeted by the Ontario Liberals. It doesn't matter whether they had that $2,000 savings or not. It will make no difference whether or not they buy a house. So this is a non-solution to a non-problem that is nothing more than PR, which I think that's basically what your BC Liberals did. The only difference is that they brought their policy in after the market was already in full correction mode, and they're going to be blamed for it.
The CMHC says the Canadian real estate market could withstand several major shocks. Why would they say that, and what kind of shocks?
CMHC, every time we hear someone talking about the taxpayer being on the hook with CMHC, that is just another economyth, is what we're saying. Basically, anytime you hear an economist talk about a housing market, they're talking myths, economists. CMHC, taxpayers being on the hook for CMHC is an economyth. Why? Even if you purchase, specifically, if you purchase a house with 5% down, you take out a 5-year mortgage. Oh, I think we've talked in your show before about this. Over the 5 years, you're going to pay down mortgage debt. For every dollar you're paying now, you're paying off 50 cents of that dollar goes towards paying down your mortgage debt. The other 50 cents goes towards interest. That is a staggering amount. So over the course of 5 years, your house price would have to plummet far more than a correction, the speed of a correction, for you ever to be negative. Now, where the problem does exist would be in the uninsured mortgage portfolio that is out there in both Ontario and in British Columbia for people who own, say, $2 million house and they got a $1 million mortgage. So in other words, they have only 50% financing. Where the risk is there is that those houses will be could be next to impossible to sell, and since there's no CMHC insurance on that, the banks are going to be the ones that are worried. It's got nothing to do with CMHC. CMHC came out with this big stress test today. They talked about earthquakes. Didn't mention tsunami, which I think in Vancouver would be bigger concern than the earthquake itself. They talked about oil prices. They talked about a 30% house price correction. CMHC isn't worried about a 30% house price correction. I don't know why anybody even talks about it. They talk about it so it looks like the government's doing the good thing, or CMHC is being the big guy. Oh, we're doing this as a favor to you. Well, that's not the truth. The only people who get hurt in a house price correction are the homeowners. They're the only ones. The only people who've been hurt out in BC right now, and they're going to find this out over the next couple of months, are the people who've lost 20% of the value of their home in British Columbia. If you were sitting with 40% down, in other words, if you owned $1 million house and you set a $600,000 mortgage in February, you had a net worth of $400,000. And StatsCan even reported that in their monthly stats. Today, if you had an appraisal done on the same house, the appraiser would have to be coming in around $800,000, 20% drop, somewhere around. They'd have to. They have no choice. If they don't, I mean, they can lose their appraisal license. But all of that loss, that $200,000 loss, comes out of your home's equity. So your net worth that was $400,000 is now only $200,000. CMHC doesn't care. They have no risk. The risk is borne by the homeowner in Canada. Canadians do not let their homes go into foreclosure because the tax benefit happens only when they sell their house at the end of owning it for 40, 50, 60 years. There is no monthly advantage to owning a home. In the United States, where people walked away from their houses, it's because there is a monthly advantage. Each month, they get to write off the mortgage interest. So when CMHC came out with this today, with all these crazy scenarios, there was one scenario they didn't even talk about. And it's the real scenario, the only one that matters. And we call that capital exhaustion. So your listeners are hearing this here first. This is another term our firm had to come up with because there is no lingo out there for how a realty market functions. Capital exhaustion happens when interest rates stay level. When interest rates stay level, whether it's at 6%, 5%, or 2%, over a period of time, there is no more money in the economy that can be put into housing. In other words, people who are qualified to buy a certain amount of house are only qualified to buy a certain amount of house unless interest rates drop or their incomes increase. We know incomes increasing in Canada is a rarity. Interest rates dropped from 1985 till 2015, but they've been basically level since mid-2015. So you're reaching a point where we have what's called capital exhaustion, where it is impossible, mathematically impossible, for people to go out and borrow any additional funds. Normally, that is mitigated with a rebalance of the market and a period of stagnation or shorter house price gains where some mortgage debt is paid off and then more mortgage debt can be assumed. CMHC didn't measure that because they don't know what capital exhaustion is. But I'll tell you, every single one of your listeners, whoever went into a bank and asked to qualify for a mortgage, the bank told them at what point their own ability to get capital would be exhausted because the bank wouldn't lend them any more money. And that's what CMHC did not discuss. And I can tell you from 2003 till 2016, there has been capital in one way or another available. How the capital has been available in Canada is we keep going to more higher and higher income earners to get them to buy houses. That's where the capital is coming from. Those at the bottom of the market who can no longer afford to buy, they've gone. And with each price increase, more and more of those first-time buyers get marginalized in terms of not being able to get any more capital to use to purchase real estate. CMHC has never, ever mentioned this function of a real estate market.
Well, all the things that you've predicted for us so far have come true. You said that we would see a huge drop in sales in the Vancouver area long before they brought in the 15% foreign buyer tax. Now, the city of Vancouver has brought in a 1% vacancy tax in the hopes that people will rent out vacant homes. First of all, will this 1% tax work?
The 1% tax is not adequate. Now, what I mean by that is that the tax should have been at 2.7%. The reason it should have been at 2.7% is that over time, housing prices naturally increase 2.7%. Your listeners will say, what are you talking about? Housing prices naturally correct. You know, our housing prices, we're told, have gone up 24%. Well, anything over 2.7% technically is a house price bubble. What I mean by that is that inflation on your home generally carries between 1.2 to 1.3% annually. And then the average Canadian spends on their home, homeowners, and this is carried on consistently from 1980 until 2016, another about between 1.5 and 1.8% a year on their property. Now, it goes up and down that amount depending on how old the housing stock is at a given in a given year. In other words, if enough new homes are added to the housing stock, the average across all homes will be a little bit lower. If not enough new homes were built, then a little bit more money per home will have been spent. Anybody who's questioning our authority on that comment only has to look at Statistics Canada, our renovation spend, and from that you can pretty much figure out what I've just told you is 100% true. So because of that, what the tax should have been applied should have been 2.7%, or at least they should have taken into consideration inflation in British Columbia over the last 5 years. The tax certainly should have been adjusted to mitigate the benefits of owning a home through inflation. And they could have also taken into consideration any specific renovation work, renewal work that Vancouver homes traditionally undergo. That being said, tax should have been 2.7%. What the Vancouver government basically has done is they basically thumb their nose at 1.7% of natural house price gain, and that means people can continue to own it and make money.
It's estimated some 10,000 or more homes are vacant during the year in Vancouver, and they said this tax wouldn't apply to the regular person. It's only if this was a second or third residence. Is there any way to make sure that this tax could be collected? Could people just lie on their forms or just keep the lights on all the time so it looks like somebody's home?
Yeah, there's lots of ways to do that. Actually, the easiest way really is to hire a house sitter and have them go in. I mean, there's a bit of irony here when I make this statement, because one of the services that we offer to our investor clients is that we do have fully certified and qualified house sitters available for them so their houses don't sit vacant. You would have to almost say, if you're owning a $3 million property, you've got to pay a 1% tax. That's $30,000 a year. $30,000 a year. You could technically pay someone $15,000 a year to live in your home and take care of it, and thus it's not vacant. So that would be one way around a loophole. Unless a government understands, I think anybody, unless you establish a policy that protects against all probable ways of counteracting the policy, then the policy is worthless. And I think that's really what you've seen here with this. I know there is a renovation exemption, is there not, Jim?
Yes.
In the policy. Okay, so I don't know if they included in the policy that how they're going to define renovation. If they were to have contacted our firm first, and again, as I've said to you before, we would have provided this information free of charge to the government, we would have simply told them that to qualify as a renovation, there would have to be a building permit issued by the city already in place. Those building permits would be a super easy way for the city to track it because they already own they already have the building permit in their possession. Do you know if they instituted a 1-800 tattletale line? Did they mention that in their press release?
I don't know if they put in a specific phone number, but they do want people to tip off City Hall if they suspect something's open.
So again, the easy solution is for, $100 a year, put a special phone line in with an automatic dialer where you can anonymously give tips to the government. Asking people to call in when they can be identified prevents people from making these type of whistleblower calls. And again, there's a bit of irony here because we know the problem with the real estate industry in British Columbia was caused because if you wanted to complain against the real estate agent in British Columbia, you had to file a complaint. And people don't like to file complaints. As, we have so many hotlines around the country where you can report tips to the police. A tips line, excuse me. Well, those simply are answered anonymously. You can leave your anonymous information. The government could simply state that we're not going to have any call display in this line, and they could follow up in the tips. Without providing that singular phone number with a commitment from the city government, municipal government, that we are not going to do any call display on this number, they're not going to get the response that they need. The solution was simple. Spend $100, get a special number, publish it, let everybody know.
Will this tax or threat of the tax be enough to encourage more stock to go on the housing market?
No. It's another myth perpetuated by those wanting to install the tax. Again, if you want to put those vacant homes on the market, then you have to increase the tax to 2.7%. So not only do you lose money in a correction, again, as Vancouver is undergoing right now, but even as prices stabilize and rebound, whether that is a year from now or 5 years from now, in the meantime, you're paying 2.7% a year, and the benefit that you're hoping to gain going forward is being eroded each and every year you have to pay that tax. 1% is not adequate.
Are there any other measures the city could have done to help increase the housing stock?
Yes, well, there's many ways that Vancouver can. Each community in Canada is different in terms of solution that you're going to have for increasing your housing stock. As I've stated here in your to you before, Vancouver is very coincidentally happens to be the same in the same type of a setting as my hometown here in Ontario is Burlington. We have a constrained land mass, even though there's lots of room to grow. All of the four boundaries of the city have been established decades ago, and there's no way to grow. So we currently are filling in our last subdivision, and when that's done, the only available resource will be infill. Ironically or coincidentally, the old city manager from the city of Vancouver happens to be the new city manager here in the city of Burlington. So, he probably will be well prepared if he ever wants to go back and take the job back out in Vancouver. Housing stock in Vancouver, what you're really looking at is they need to put incentives to take up the vacant land. I think you've got a surplus really of golf courses. I'm going to use this one example of golf courses when I did an overview of Vancouver. I think we noted 2 golf courses that really don't need to be there. In other words, very few percentage of the population is availing themselves of the use of that golf course. The owners of the golf course, certainly, whether it's a city or anyone else, would be happy to sell it because they're going to get some big money out of it. You're going to lose green space, but that green space is only accessible to those using the golf course anyway. So there's one solution for you. Second solution, and a more important solution, is the city really could designate entire blocks of homes. So let's say that you just go in and you pick one block of homes, single detached homes in Vancouver. And the city could say, we're going to designate this specific block for redevelopment, and we are going to do it so that there's a densification, but it's a densification towards townhomes. Now, a townhome really is the same as a single detached home. You still have a front yard, you still have a backyard, you still own your own unit. Although you may share two walls if you're on an interior unit, on the outside units you only share one wall. So on those outside units, at least there's multiple windows. So the city could also use those blocks and designate them for quads, so that each of the 4 units that is built has windows in all 3 corners. They all have their backyards. They all have a front yard. This would also eliminate the laneway issue. There's been a lot of confusion that has taken place over these laneway homes. And where the confusion the laneway home has is with the Canada Revenue Agency. What you never hear discussed in Vancouver is how capital gains is lost the moment that you install a laneway home. Whether you do a handoff to someone else in your family of that property where the laneway home is built, or you maintain the property yourself and rent it out, that automatically brings capital gains, and all of the capital gains exemption on the principal residence technically will be gone. And if you should divest of that real estate, of that principal residence, then you're going to either have to pay capital gains or attempt to lie to Revenue Canada, and either way you're going to lose. So this laneway solution is really not a solution. The solution really is we're going to designate teardowns, we're going to designate block at a time, or we're going to issue permits on the corners of all 4 corners of a city block, so that densification can take place there. It's going to be low-rise densification, in other words, townhouses instead of high-rises. I can take any city block, in the average city block in the city of Vancouver, and I can increase the number of homeowners on that city block by about 6 times. All of them would be happy. They all would be able to afford the homes that were built there. You got to restrain your developers. So that is really the easiest solution. You attack the vacant land that you have, certainly reclaim some of, the lunacy of this UBC being on the land that they're on, I can't understand. But I mean, I'm from Ontario. I'm not from British Columbia, but I certainly would be looking to get some relief in that area as well. And I am a firm advocator, as a home ownership advocator, that light rail transit increases, so that if we're talking jobs and those jobs are existing in Vancouver, that you're getting people within a quick 30-minute commute is important. A lot of the confusion over transportation and the home ownership market is distance. Distance is not the problem. Time is the problem. If you can travel 100 miles in 30 minutes, you can move 100 miles. You can move 100 miles away from your city. If it takes you 15 minutes to go, or 30 minutes to go a kilometer and a half from your work, it's the exact same thing to a homeowner.
Ross, where can people find out more about that?
You're welcome to go to thewealthyhomeowner.ca for consumer intelligence on your local home. And if you're a professional investor, you're welcome to visit rossk.com and we can help you there.
My guest has been real estate consultant Ross Kay from the wealthyhomeowner.ca. Coming up, Hilliard MacBeth next on This Week in Money.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Hilliard MacBeth, author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash, and portfolio manager and financial advisor in Edmonton. Welcome back to This Week in Money.
Nice to be on the show again. There's a lot's happened since we talked last.
Hilliard, Ross Kay just told us that the Canadian real estate market is turning down when real estate bubbles burst. Does it take a while for most people to notice the downturn?
I think it does. I think people have got a very ingrained idea that house prices always go up, and unless they're really forced to confront reality, I think people's tendency, not just on housing, but on a lot of things, is to sort of remain, maybe in denial a little bit. And so what happens is maybe a neighbor gets into financial trouble, maybe they get laid off from their job, or maybe there's a divorce, and then there's a sale that goes through, and the price is a lot lower than people thought. But even then, they can still rationalize it and say, yeah, but that's a one-off thing. It's not real. So yes, I think it takes quite a long time for people to come to grips with the idea that, it really was 15 years of rising prices. So it's they're not going to notice in just 1 week or two that the tide has turned.
When people finally realize real estate is crashing, do they rush to list their homes, and why?
I think they do not rush to list their homes unless there is a catalyst. Like, for example, in Alberta, we've had a recession. Now we're into our second year of recession. And yet there's still a lot of people that are hanging on to their homes. In some cases, that I know of personally, where probably they should be moving more quickly. One of the interesting things that's happened, a story from a lawyer that I know, is that there's a stack of cases at the courthouse of people where there's a couple that's trying to split up. And one wants to sell the house and one wants to hang on to it, and they can't agree. So they have to go to the court, and the court decides. So there's a real reluctance to sell. And one of the things that happens is people say, well, I'm not selling, if that house is worth $600,000 and now you're telling me I have to list it for $499, I'm just not going to accept that. That's too low a price. And so they hold off. So, eventually they get forced to sell, or they just decide to hang on forever. A lot of that happens too. I mean, in previous downturns, people would hang on for literally 20 years to wait for the price to get back to where it was.
Are mortgage rates headed higher, and how will that affect the bursting bubble?
Yes, mortgage rates are headed higher, and it will be a major problem. So basically, what's been happening in the new housing segment, where you see it more than you do in the resales of existing homes in Alberta, is that people were barely able to qualify for the homes that they were trying to get into. So brand new, beautiful home, maybe $400,000, 5% down, possibly borrowed from mom and dad or whatever, and their incomes and everything else were such that they could barely qualify. So if you take the rates and even move it up 0.5% or 1 full percentage point, or heaven forbid, two full percentage points, there's a whole swath of people that can no longer qualify. But on top of that, we've got the changes in the CMHC rules, which are also going to affect that, because the underwriting standards are being tightened up, and they should never have gotten as loose as they did. And so these tightening up is really more just going back to the way it used to be. But that's going to have a big impact on people's ability to qualify. And as you and I have talked before, that first-time buyer that's maybe coming out of mom and dad's basement or whatever, they're crucial to keeping the housing market going because they buy the product and then the person can move up to the next home and so on. So it works all the way up the chain.
At what point are home equity loans in jeopardy?
Well, that's a really good question that people don't talk about that much. And this is that phenomenon where people, as the property prices go up by 20% or 30%, and the index overall for Canada has doubled since 2005. So just in 11 years, it's doubled. The people that bought a few years ago have this enormous amount of equity in their home. And what they've been doing is they've been borrowing against that. So that's called a home equity line of credit. And it used to be called a second mortgage, but that had a real negative connotation. So they made it sound more sexy. So they shortened it to HELOC. So the HELOCs support a lot of spending in society. So people could go out and buy a second property. They could buy a car. They could go on a vacation. They could help their kids get into housing. It's one of the reasons I wrote the book was watching people that I knew going deeper into debt. After they'd been mortgage-free, they got sold on the idea that, hey, you've got all this equity in your home. Why don't you use it to do something, help your kids out or something? So they would go and that's been one of the most, to get back to your question, that's been one of the most rapidly expanding segments of consumer debt. And it's very dangerous because depending on what they did with that money, you could argue that a debt for a mortgage to buy a house is what they call good debt. I might not totally agree with that, but let's just for a minute, let's let that stand. So the good debt is the mortgage, but once you start layering on additional second mortgages and third mortgages, or HELOCs as they're called, to do other things, then you get into the real danger territory. And those numbers have gone. The number I just saw this morning was $265 billion. So it's not as big as the mortgage. The mortgages are $1.3 trillion. So it's about a quarter of the size of the mortgage market. But it used to be not that long ago. It used to be under $100 billion. So this could be the canary in the coal mine in terms of, and the other thing about HELOCs that is just dangerous is, unlike a mortgage, you're not required to pay back every month a small fraction of the loan like you are with a mortgage. There's no amortization on a HELOC. So you can just let the loan accumulate and even add the interest on the loan back to the principal. So the HELOC can be something that you just dip into. And it's just so convenient and so easy to get deeper and deeper into debt with a HELOC. You don't have to go and sign a new paper every time you borrow. So I think that's one of the real danger points.
The CMHC just released some stress test scenarios. Could a bursting real estate bubble put the CMHC in jeopardy?
Well, according to the CMHC, no. So it's kind of like, I literally almost laughed out loud when I saw that because they're talking about if there's a severe downturn in housing of 30%, which is pretty severe. There's been a couple of those in the last 40 years, but only a couple. There was massive unemployment. There were huge financial organizations that went bankrupt in a 30% decline. But the CMHC said that they would only have a $1 billion loss, which is just, literally, I'm not kidding. I almost laughed out loud when I saw it. The total obligation the CMHC has is $526 billion. So 1% of that would be $5 billion. And of course, how it works when the person defaults on the loan, the bank takes the loss and goes to the CMHC and says, you have to cover us because you're the insurance company. And not only does the insurance company have to make up the money that the bank lost on the house that defaulted, but they also have to pay all the legal fees, all the accounting fees, all of the associated fees. So, I really don't know what they're thinking when they say $1 billion. It's going to be many, many, many billions of dollars that they'll be in the hole. But we won't know until downturn comes and people start defaulting. And of course, we don't know their methodology. They did not. They came out with several stress tests, but they didn't say what the assumptions were. The big thing in any stress test is what assumptions are you making to come up with that number.
What kind of an effect is that going to have on Canadian real estate sales that you have to go through this stress test now? Well,
I think that the other stress test that you're talking about is the stress test where they are the young couple that comes in and says, can we qualify? How much can we qualify for? And they're going to borrow at, say, rates are rising right now. Let's say 3%. It used to be 2.5%, but I think, it's going up maybe to 3%. They would qualify for a big loan at 3%, but the government has decided, as of just a couple of weeks ago, that they're now going to have to qualify for a higher number. And the reason for that is they're going to say, okay, during the life of that mortgage, 25 years, the rates are probably on average going to be higher. So at the moment, the posted rate for mortgages is 4.64%. Nobody has to pay that much. People pay a lot lower than that, but they're making that young couple qualify at 4.64% instead of, say, 2.5%, 3%. And that's going to, again, eliminate a lot of people out of the qualification game. So they're basically, all of these changes are leading towards the situation where there's fewer people that can qualify for that first house, and it's going to be hard on the housing industry. It's going to be hard on the economy. It's going to be hard on everything, and they're not done yet. The head of CMHC, Evan Siddall, who's 3 years in the job as of next month, gave a speech in London, England, to the Bank of England, and he said that it's very dangerous that people are making such low down payments on housing. So he's come out in public and said the down payments have to be much larger. So a combination of rising interest rates and bigger down payments, you're talking what back to a sanity in housing, but also in the short term, it's going to be hard for those people that are trying to sell houses to sell them to the young couples. So hopefully there's lots of foreigners that can make up the difference.
Looking at other areas of the Canadian economy, how are autos, retail, and jobs doing?
So the job situation is very difficult in Alberta, as you know, and the unemployment rate as of a month ago went through the peak that was hit in the 08-09 global financial crisis. And of course, everybody will know that Canada kind of skated through that 08-09 crisis with less trouble than the U.S. But so the peak unemployment rate in Canada was quite a bit lower than the U.S. back then. But there was still a pretty big peak, and now we're in Alberta. We're through that peak, and unless the lower dollar somehow magically, or as expected, actually they were hoping for a big surge in new business due to export of manufacturing goods and that sort of thing. That there's a lot of trouble with the unemployment situation, because a lot of those people actually were commuting to Alberta and working in Alberta, and now they're going back home to Ontario. And when they get home in Ontario or Newfoundland or wherever, they apply for employment insurance back home. So we're going to see a rise in employment as we have in Alberta. I think we're going to see it in other places. Now, I did notice in Vancouver that there's a lot of construction still going on. The latest numbers showed a big drop in the construction, but there's a lot of construction projects that haven't been finished yet. So new starts are shrinking, but existing projects are at record high levels. And apparently a lot of people have moved from Alberta to BC to finish up those projects. But once those projects are done, then you're going to see a big jump in unemployment. And of course, without going back to the retail sales, which you also asked about, people, there's this thing called the wealth effect. When people see their house price going up, they feel like they have lots of money. They can get a HELOC and borrow against the equity in their home and go out and buy a car or a boat or an RV or something. As soon as that starts to go the other way, they feel poor. They feel like they're less wealthy, or they feel poor, and they start to cut back on retail spending. And that's going to be the next shoe to drop. I don't think it's dropped yet, but we're going to see people starting to hunker down. And what they'll do is they'll accelerate their mortgage payments to try and hang on to their home, but they'll cut out other spending. Although I am quite surprised at how the spending is held up in Alberta, even though the incomes are dropping. So people are the habit of eating out in restaurants and going on holidays and stuff like that is very strong. So people generally don't give that up right away, but eventually they will give it up, and they'll concentrate more on paying down their debts. And that's when you see the real impact on the economy, is when they start changing to paying down their debts rather than adding to their debt pile.
What about the Canadian consumer debt bubble? How is it going to shake out?
It's spectacular. The Canadian debt bubble. There is one country in the world that's even more spectacular. That's Australia. But the Canadian debt bubble is not far behind Australia, and it's spectacular. It's never before has household debt been 100% of GDP. You don't have to go very far back to where it was more like 50% of GDP, just probably 10 or 15 years. And basically in economics, they don't handle debt very well in economics. They don't know what to make of it, so they kind of ignore it. But the basic thing that they say about debt in economics, which is true, is that debt is future consumption brought into the present time frame. So all of that debt is money that could have been spent 5, 10 years down the road or 1 year down the road. People decided because they wanted it right now. They wanted the shiny and new right now. They decided to borrow what they wanted. So of course, what that means is because it's been such a huge phenomenon that there's a whole bunch of spending that's been brought into the present, and therefore the future is going to have a lack of spending, and that's the difficult thing. So there's basically, you can go through a recession and wait for people to get their feet back under them, and maybe some of the debts get eliminated in bankruptcy. I'm sure there'll be quite a bit of that. Or you can just allow them to keep borrowing more and more money. Well, eventually you get to the point where they just can't qualify for bigger loans, and my sense is we're kind of pretty close to that point now. So that means we have to put up with a recession, and people basically pay back their loans for a few years. Japan's been going through this now for 25 years, and they seem to have just about come out the bottom of it, where it's called a balance sheet recession, and it's hard on the economy. People save money instead of spending, and which of course means auto sales are going to hurt badly as well. There's been record auto sales in North America for a couple of years now, and the latest numbers show that it's starting to slow down a little bit, and it's basically all about borrowed money as well.
Is there optimism that President Trump will be better for the Alberta oil patch? He's pro-pipeline.
There's a couple of positive things about Trumponomics, if you call it that, when it comes to oil, and there's a couple of negative things. So the positive thing is the Keystone Pipeline, which I know that the leaders in Canada have been mentioning that we need our own outlet to the Pacific Ocean, but that might be difficult to get the approval going through BC from Alberta. But the Keystone would really help because there's a lot of demand for Alberta crude down in the southern part of the United States on Texas and Louisiana, Gulf Coast. And it doesn't really matter to Alberta producers where it goes. They just would like to sell it. And so that's a very positive thing. There is a negative, though, with the oil patch with Donald Trump, and that is that he's stated that he wants to get rid of foreign suppliers of oil. The U.S. has a lot of oil, and now they found all this new oil in the Permian Basin, but they also have this thing called federal land. So far, all of the fracking, the shale, has been mostly on privately owned land, and in the U.S. there's not very many restrictions on that. But the government crown land, they don't call it that, they call it federal lands down there. There hasn't been very much drilling allowed at all, and that shale extends onto federal lands. So Trump has said that he's going to open up federal lands to drilling, which will have a big impact on the availability of oil in the United States, and they may not need our oil. Right now they import about roughly 9 million barrels, and they produce about 9 million barrels, so total consumption is about 18. Canada provides probably 3 or 4 of that 9, so we're around a third to 40% of their imports. If they cut back on imports, we might end up sharing. Maybe they'll exclude Saudi Arabia and other countries like that, and Canada will still be able to sell as much as we want.
Hilliard, thanks for being on This Week in Money.
Nice to be on your show again.
My guest has been Hilliard MacBeth, author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. Coming up, Payton Nyquvest next on This Week in Money.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the 4th largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. My guest is Payton Nyquvest, Vancouver investment advisor at MackeyResearch.com. Welcome back to the show, Payton.
Thanks for having me.
How did the Canadian equity markets do this past week?
The TSX had a high of 14,872. Low was 14,509, closing at 14,864 for the week, so up about 294 points. TSX Venture had a high of 756. Low was 717, closing at 746, up about 18 points for the week. And the CSC had a high of 870, low 776, closing at 839, up 46 points for the week.
How did declining gold prices affect the Canadian markets?
I think the gold miners and continuing to have a little bit of pressure, probably more so on the fact that a lot of these gold companies had all gone out and done private placements here in the last probably 4 or 5 months, which are all now coming free trading. So, the gold price obviously affects that, plus a lot of free trading stock all coming out around this time up until Christmas. So there's probably more pressure to come here, I would say, until the new year.
Is there optimism in the junior marketplace that Prime Minister Trudeau seems to be going out of his way to meet with other countries other than the U.S. to tell them Canada's open for business and open for investment?
Yeah, it seems like things are opening up a bit. I know there's a couple groups that have gone down to Australia that are bringing in Australians into the Canadian market. So you're seeing a bit of that open up, but the driver is definitely here at home.
Are people worried that the U.S. will shut its doors to outside investment, or it'll be hard to get money out?
I haven't heard of that yet. I don't think it's too much of a concern.
Are Canadians going to be looking still to the south to look for investment money? Is Canada still a bargain, especially considering the low value of the Canadian dollar?
Well, the U.S. has always been a big driver in the Canadian markets just because of the size, and I think that'll continue to happen. I don't really see that slowing down much.
I know the U.S. market saw a big boost in marijuana industry action. What about Canada?
Yeah, no, the marijuana markets in Canada have definitely been the hot sector. You see companies like Canopy on it was Wednesday or Thursday, stocks went from about $10 to a high of 18, came back to 10, traded I think it traded about $240 million worth of stock in one day. So there's a ton of activity there. If you look at the charts on all these marijuana stocks, especially if you're a licensed Canadian producer, they all have these rocket ship trajectory charts.
Yeah, it's interesting. It'll be hard to move product across the borders of Canada and the U.S., but once you're in, you're in.
Well, yeah, and the interesting thing still, and we've talked about this before, but definitely the interesting thing will be, when they finally do draw a line here and figure out what they're going to do in terms of recreational use and legalization.
Payton, thank you so much for chatting with us.
Thanks for having me.
My guest has been Payton Nyquvest. He's a Vancouver investment advisor at MackeyResearch.com. That wraps up our show for this week. We'd like to thank our guests, Ross Clark, Ross Kay, Hilliard MacBeth, and Payton Nyquvest, and thank you for listening. Any questions for the show can be emailed to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.